Still a 65% chance of a hike in November.
Growth is fine, but is it too good?
Good is bad again.
The Chinese market, it certainly looks a lot better to us than what the news reflects.
For September to go right, you can't have earnings revisions lower. Right. You can't have yields continue to go up.
That's right.
You can't have inflation data come in on the wrong side of what the narrative has been. Maybe some would say you can't have good economic data because that is now bad. Good is bad again.
Good is bad from the Fed's perspective, but now we've all just sort of accepted the idea that rates were going to be higher for longer. Still a 65% chance of a hike in November. So we might see another pause through September. Then you got a built-in pause in October. In November, if they hike again, personally, I don't think they need to, but if they hike again, the market gets to the point where it says, now we really cannot sustain these valuations anymore. There is a lot of data coming in this week. We've got some GDP data, we've got PCE, we've got jobs coming, really low volume. This is pretty normal for this time of year. The one thing that low volume does present the opportunity for, though, is that if there's a surprise or a bad data point or some sort of shock, it's that things move much more quickly in either direction, particularly on the downside.
Bespoke points out it's not typically a weak month when the S&P is already up double-digit percentage points year to date through the end of August. The data's got to cooperate. Yields have to cooperate. The data's got to be good, but not too good on the economy. Earnings estimates can't get revised lower. And then you need tech to perform, don't you?
Most people expected that there would be some give back. Even the bulls, even the tech bulls expected that there would be some give back. That's not a bad thing. I think it's healthy for the market.
We're seeing out of China, I know the data and the news flow is bad, but if you look at the chart of the Chinese market, it certainly looks a lot better to us than what the news reflects. It's not a bottom yet. It's not leadership, but it certainly is bobbing along. And I think there might be some upside surprises there as we go forward.
The economy is different than the market. The market may be anticipating more stimulus and easing from the Chinese.
And we go through and look at the data that we use to get an idea as to where we are in the cycle in China. We're actually in a pretty good spot. It's not the best spot, but some incremental improvement in growth goes a long way there because they really have tackled inflation. Inflation tends to be one of the biggest drivers of the equity markets there, and inflation's in a good spot for the Chinese in terms of the equity performance. So I think there's something to that, and we'll continue to watch it. I mean, I think it is early, but I don't think it's early by a year, and I don't think it's early by 6 months. It might be early by a month or 3, but I think it's actually in a pretty interesting zone right here.
This kind of 3% pullback in the market was not because of growth concerns. It's kind of like a high-class problem. Growth is fine, but is it too good? What we got from Chair Powell was at least a nod to the fact that they have to be really careful when they're so restrictive. So, too much tightening would risk growth. But Morgan, on a scale of, a hawked up scale, 10 being most hawkish, they're still at about a 7. The base case should be that they're going to be on hold, but the risk is that a combination of either very strong housing or employment data just rekindles an inflation concern that they want to get in front of. Our recession probability is only 20%. So if there's like 3 scenarios, hard landing, no landing, soft landing, we're firmly in the middle at the soft landing camp. My biggest competitor is still the 3-month T-bill that everybody thinks is this great story. Cash for us is okay, but we would rather get more yield in credit than in cash. I wouldn't be underweight equity here. Again, if I think that we're not going to be in recession and we think that the Fed is just about done with their tightening cycle, this broadening out story that Bob talked about, I think makes a lot of sense as well. That kind of keeps equities marching higher. If this is a rally that's based, again, on the fact that the U.S. economy can grow at about trend and the Federal Reserve can pause, not ease. I don't want them to ease. If they're easing, we're in recession. That's not good for equities. But if we're in this soft landing environment where the Fed can pause and just keep rates at these levels, that's going to be lower VIX, lower rate volatility, good for the equity market, Morgan. But right now, while we're still waiting for the data, I would just rather pick up the yield in the portfolio than the equity risk. And that's the story.